The fourth goal of this chapter is to compute depletion and journalize the entry for depletion. Natural resources are land and other things in nature that the company might own. So the process of transferring the cost of those natural resources to an expense account is called depletion. It's like depreciation, except for natural resources don't depreciate, they don't become lower in value, they become depleted, they become gone. So we have an example. A business paid $400,000 for the mining rights to a mineral deposit estimated at 1 million tons of ore. So these mining rights, it's mining for some sort of natural resource, in this case ore, and it doesn't depreciate, but it depletes. The ore is gone, and that's what causes it to lose value. So step one is to determine the depletion rate per ton. This is kind of like when we were doing depreciation, same kind of concept, except for it's a different term, depletion. So we take our cost of our resources divided by the estimated total unit of resources to get a cost per unit, which is actually our depletion rate. So let's go ahead and actually calculate that depletion rate. You would take your cost per ton of ore, so cost of 400,000 divided by 1 million tons of ore, that is 40 cents per ton. The second step is to multiply the depletion rate by the quantity extracted during the period. So if we say that we extracted 90,000 tons for this period, we would take our depletion rate of 40 cents per ton times 90,000 tons. Ignore this dollar sign. That should not be a dollar sign. It's tons. And we get $36,000 of depletion. Not depreciation, but depletion. So we need an entry to record the depletion. So if you think back to our entries where we recorded depreciation, we debited an expense. In this case, we're going to have a depletion expense. We're writing that off instead of a depreciation expense, a depletion expense. We debit that expense to increase that expense for the year, $36,000, which you calculated in the previous slide, and we credit accumulated depletion. If you replace these words with depreciation, we've done that before, except for, again, natural resources don't depreciate, they deplete. Let's take a look at an example. Earth Treasures Mining Company acquired mineral rights for $45 million. The mineral deposit is estimated at 50,000 tons. During the current year, 12,600,000 tons were mined and sold. If you need to review the last couple slides to look at how we calculated depletion and the steps, flip back and review. Otherwise, try to calculate A, the depletion rate, so the dollar amount per ton. Determine the amount of depletion expense for the current year. Take your rate, multiply it by the tons that were mined, and do the journal entry just like we would do with a depreciation expense, except in this case, since it's a natural resource, it depletes, so it would be a depletion expense. Pause and calculate. For letter A, you should have gotten 90 cents per ton. The $45 million total divided by the $50,000 tons, or 50,000 tons that the mine is worth, will give you 90 cents per ton. For letter B, we had 90 cents per ton times the 12,600,000 tons means an expense of 11,340,000. Then we do our depletion entry, depletion expense of 11,340,000, and accumulated depletion. Our fifth goal is to describe the accounting for intangible assets such as patents, copyrights, and goodwill. Intangible assets include things like patents, copyrights, trademarks, and goodwill. They're long-lived, so they're around for a long time, and they're useful to the business, but are not sold. They're called intangible assets because we can't physically hold them. We can't physically hold a patent or a trademark or a copyright. They're just something that is assumed upon. So more specifically, a patent is an exclusive right granted by the government to manufacturers to produce and sell goods with one or more unique features. So we patent something because it has a unique feature and nobody else can use that unique feature. You can also patent a process. We have a unique process and we can protect that. they continue on for 20 years. So we have a patent for 20 years. That's important to remember. So how do we amortize a patent? Basically, amortizing a patent is we have them for the amount of time that it's going to be useful and we're going to use it and have that advantage. We have to get rid of the value as it becomes less useful. So it's kind of like the depreciation, the depletion we've done, but it's called amortizing, another vocabulary term. So at the beginning of the fiscal year, we get a patent right for $100,000, and we assume that it's going to be useful for 5 years. Although we have it for 20 years, somebody else may become better, technology may change, so it's really only going to be useful for 5 years. So how do we journalize that? We have an amortization expense for patents of $20,000, and then we credit patents for $20,000 each year. How did we get that? $100,000 is the price of it overall, divided by the 5 years gives it $20,000. We debit the amortization expense for patents. To increase that expense, it costs us to have that patent useful. Patents are assets, so we credit that assets to decrease it. So now the patent really only has $80,000 worth of value left in it after that year. Because a patent doesn't exist physically, it is acceptable to credit the asset. That's different from physical fixed assets. Fixed assets have to have a contra asset account. So since it's intangible, we can't touch it. It's a theory. We can actually credit it. We can actually take value away from it, where we don't do that with a fixed asset. Copyrights are for things like artistic, musical, or literary compositions, and that extends for 70 years beyond the author's death. So as long as the author or creator of that literary piece, artistic piece, musical composition is alive, we have the copyright, plus after they die 70 years after it is still protected. Trademark is a unique name, term, or symbol used to identify a business and its products. Most businesses identify their trademarks with the little circle R in their advertisements. They can be registered for 10 years and renewed for 10 years after that. If you look at trademarks, logos are a common trademark. If you look around our classroom, you'll see logos. Those would be a trademark of the business, and they can protect that. Goodwill is kind of an abstract concept. It refers to an intangible asset of a business that is created from favorable factors such as location, product quality, reputation, and managerial skill. These are things that are added that other people can't take away. Your location is your location. If you have the best location, that's it. And that's part of goodwill. You have good quality. That gives a good reputation to your product. That's goodwill. GAAP permits goodwill to be recorded in the accounts only if it is objectively determined by a transaction. So we'll talk about this here. We've got a loss to be recorded if the business prospects of the acquired firm and the acquired goodwill become significantly impaired. So if for some reason our location changes, our reputation changes, our quality decreases, then we should record a loss on that. To do that, we can actually debit loss from impaired goodwill, and we credit goodwill. So the value of the goodwill has decreased, and the loss needs to be calculated in some way. There would be some sort of transaction to do that. It's just important that you understand the concept of that. You will not be asked to journalize goodwill. So a comparison of intangible assets. This exhibit is in your book. It would be a good exhibit to study and memorize so that you know what each of these intangible assets is, how long it is amortized for, and what expenses are used to record them. Here's an example, impaired goodwill and amortization of patent. I will not on a test ask you to do the goodwill, but you will do one example here because it gives you the amounts and it gives you the transaction. It's estimated on December 31st that goodwill of $40,000 was impaired for whatever reason. In addition, a patent with a useful life of 12 years was acquired for $84,000 on July 1st. So you need to journalize the adjusting entry for impaired goodwill and for the amortization of patent rights. Review the previous slides where we discussed this and try to do your journal entries. Pause this and return when you are done. The loss from impaired goodwill gets debited for $40,000 and goodwill gets credited for the example of that loss of goodwill. The amortization expense of the patent is $3,500. The math is shown there. We have $84,000 over 12 years, and then we're actually doing 6 months of it. So you can see 6 months comes from, we acquired it on July 1st. There's 6 months left in the year, so it's a partial amortization, and that's a $3,500. We credit the patents to take the value out of it. Since it is an intangible asset, we can credit it, and then we debit amortization expense. The final goal of this chapter is to describe how depreciation expense is reported on an income statement and a balance sheet to include fixed assets and intangible assets. Here's an example of a balance sheet. Intangible assets shows under its own heading, and the patents, copyrights, trademarks would be beneath that. So intangible assets are separate from property, plant, and equipment, or fixed assets. It has its own category. Intangible assets are usually reported in the balance sheet, and then they'll have a note with a separate listing with details about intangible assets. The balance in each class of intangible assets should be closed net of any amortization. Basically, that means what was it worth originally minus the amortization. That's the value that shows up on the sheet. The cost and related accumulated depreciation of mineral rights are normally shown as part of the fixed asset section of the balance sheet. This information is good to know. It's something to be familiar with, but don't worry too much about memorizing it as long as you have a general concept that intangible assets are set as their separate section on your balance sheet. This concludes your notes for Chapter 9.